Okay, this is chapter 11, part 2 of going through our slides. Okay, here's where we left off, right? We said our capital assets are going to be long-term or short-term capital gains. Inventory and accounts receivable will always be ordinary income or loss. Short-term business assets, right, other things other than inventory and accounts receivable will be ordinary. But once they've been held for more than a year, they become 1231 assets. So let's talk more about 1231 assets. These things are depreciable or amortizable assets or land used in a trade or business and held for more than 1 year, right? So we've got 3 requirements. Depreciable, and I'll leave out amortizable, but that's implied. Depreciable assets or land used in a trade or business held for more than 1 year. All right, so would an automobile used in a business held for 6 months be 1231 asset? No, because it hasn't been held for more than 1 year. Stock held by a corporation for 2 years. No, it's not depreciable, right, or land. A warehouse used in a business for 5 years. Yes, right, it's a depreciable asset used in a business held for more than a year. An unimproved lot held for investment for 2 years. No, it's not used in a trade or business. Unimproved lot used as a parking lot in a business for 2 years. Yes, that's a 1231 asset, right? It's not depreciable, but it's land used in a business held for more than a year. Machinery used in a business for 7 years, definitely a 1231 asset. All right, so why do we take all these pains to define a 1231 asset? 1231 assets get special tax treatment, and right, we call it best of both worlds treatment, because if, right, we're going to take all of our 1231 assets, net together the gains and losses. If I end up with a net gain, it's treated as a long-term capital gain, which is good, right? It gets preferential tax rates. If I net together all my 1231 gains and losses and I have a net loss, I get to deduct it as an ordinary loss, right? So the ordinary losses are more valuable, right? Because they go against higher rates, right? So that's good, right? If it's a gain, it's a long-term capital gain. If it's a loss, it's an ordinary loss. So, right, that's good. You might be saying, what? Right, the tax code actually let me have special treatment. And it does. It turns out this is too good to be true. If you consider Ashley, she runs a ski shop, and she has land she bought for $10,000 and a computer she bought for $10,000, right? And the next year she sells each one for $12,000. You can think about what the tax consequences would be, right? The land, right, her basis is what she paid for it, right? There's no depreciation. So her amount realized of 12, she'll have a gain of $2,000. The computer, right, same initial basis, right? But because it's depreciable, she can take depreciation deductions. Her in year 1 and year 2, her adjusted basis becomes smaller. The thing about these depreciation deductions was, right, in year 1 and year 2, they reduced her taxable income. So she saved $3,600 times whatever her marginal ordinary tax rate was. When she sells the computer then, right, now we see her basis is lower. So this depreciation has lowered her basis and given her a bigger gain. Right? And so she will pay more tax on the gain, right? But since it's a 1231 asset and the gain is treated as a long-term capital gain, that means this gain is taxed at 15%. Right? I broke down this 5,600 because you can see 2,000 is because the value of the asset increased above what she paid for it. The other part just comes because depreciation made her basis smaller. So she's paying more tax on the gain than with the land where there was no depreciation. But this is offset by these depreciation deductions that she got. So she got 3,600 times her ordinary rate, and when she pays the gain, it's only taxed at the lower capital gains rate, right? So it would just be a money machine for her. So Congress came in and said, not so fast, too good to be true. So what we have to do now is some of these net 1231, or just of every 1231 gain, has to be recharacterized as ordinary income. We call this recapture. It doesn't change the amount of the gain, it just changes the character of the gain. If you have a loss, right, it doesn't change, right? The loss is always ordinary. So it's going to be a little different depending on what type of asset you have, right? So stick with me, right? Things are starting to get a little more messy. You have to spend some time. Once you can start to process these and go through examples, it starts to make sense. There's a logic to it, but it's a lot in the beginning. So personal property, right, versus real property. So by personal property, remember, we mean it's still used in a business, but it's not real property. So we have all of our 1231 assets, right? These are depreciable assets or land used in a business held more than a year. We're going to now divide these into a pure 1231 asset is land. Because there's no depreciation on land, it's simple. We don't have to recapture anything. Now we'll have 1245 assets. This is going to be depreciable personal property, amortizable intangible assets. And then we're going to put real estate separately, and we're going to call that section 1250. So these are all still 1231 assets, but now some of them are also 1245 or 1250. So 1245 property, this is where our main recapture is going to happen. These are personal property and amortizable and tangible assets. These are assets where, right, we've gotten depreciation deductions, right? So that depreciation, as we saw, could make our gain bigger. So any amount of gain that comes because of depreciation is now going to be recaptured. And instead of being treated as a 1231 gain that gets better treatment, it's going to be recharacterized and called ordinary income. So if I sell a 1245 asset, personal property, right, then I have to take the smaller of the total gain or the accumulated depreciation, and that amount becomes ordinary income. Any other gain that's left will still be a 1231 gain. Right? If I sell an asset at a loss, I don't have to do any recapture. It's just a 1231 loss. So there's three things that could happen, right? So I like, there's a nice picture we'll show in a second. Most of the time you think, right, if I'm selling a business asset and I have a gain, well, assets, right, especially assets that are used in a business, they don't tend to increase in value, right? They probably, right, they're just getting used. And so they're going to go down in actual market value. So if I have a gain, it's most likely solely because I took depreciation and that made my basis smaller, so that my basis was less than amount realized. Right? Some assets, right, might be rare, or the demand goes up, right? For example, maybe if I owned a bunch of ventilators, right now, the demand went way up, I could sell them for more than I paid for them. So then I could still have part of the gain is caused because depreciation lowered my basis, and part of the gain will be because the asset actually increased in value. The third thing that can happen is I sell it for less than my basis, even after depreciation, and I just have a loss. So here's a nice picture that describes that, right? So suppose, right, I bought an asset and I paid $510,000 for it. And over the life that I've had it in service, I've deducted quite a bit of depreciation, right? So that now, right, I've deducted about 300,000. So now my adjusted basis is 191,173. So now what happens is going to depend on my sale price. So, right, so this was my initial basis, adjusted basis due to this depreciation. So if I were to sell the asset for 200,000, it's higher than my basis, but only because of this depreciation that has brought my basis down. So in this case, all of that gain is going to be recaptured as ordinary income because all of the gain came from depreciation. Or I could sell it right now. There's been actually some real increase in value, right? And then the rest of my gain is due to depreciation, right? So in this case, all of this, right, the lesser of my total gain or accumulated depreciation, this part becomes ordinary income. And the difference between my original cost and the sale price of $520, this $10,000 is still a 1231 gain. Right? The last thing that can happen is I sell it for less even than my adjusted basis. And so I simply have a loss, right? My amount realized is 180 minus my adjusted basis gives me a loss of 11,173. And we'll call that a 1231 loss. So in practice, we would expect the most common thing to happen would be, right, I'm going to sell it for less than I paid for it. So I'll either have everything recaptured as ordinary income or I'll have a 1231 loss. All right, so suppose Scrap Happy sells a machine, adjusted basis is 6,000 and their amount realized is 10,000. All right, so I can see that, right, I have my $10,000 adjusted basis minus, oh, sorry, that's my amount realized, minus the $6,000 adjusted basis. So we know I'm going to have a $4,000 gain. The question is, what is the character of the gain? The problem tells me depreciation taken on the machine amounts to 2,500. So the lesser of my depreciation or my gain is what gets recaptured as ordinary income. So 2,500 of this is going to be ordinary income, right, that gets recaptured, right? This gain is as big as it is because 2,500 of depreciation made the basis smaller. The rest, right, the other 1,500 is still called a 1231 gain. All right, so that's that. The other thing you could see, right, you can think about it. So if my adjusted basis is 6,000 and we've taken 2,500 of depreciation, that means, right, my initial basis was 8,500. That was the cost, right, initial basis. And the 2,500 of depreciation has brought the basis down to 6,000. So you can see then, if they sold it for 10,000, then 1,500 is the actual increase in value, and 2,500 of the gain is just from depreciation. So let me see here if we do that here, right? So in slightly better writing, what I just did, right? The lesser of depreciation or gain gets recaptured as ordinary income. The rest of the gain is a 1231 gain, right? That's an actual increase in the value of the asset. All right, let's go back to our example where we showed why we have recapture. Ashley sold her computer and her land. The land, right, nothing will change because there's no depreciation. On the computer, right, she sold it for $12,000 minus her adjusted basis, right, which is lower because of the depreciation that she's taken, gives her a gain of $5,600. So we can see, right, 2,000 of that is a real 1231 gain, right, because the difference between her cost and what she actually paid for it. 3,600 of it is just because that 3,600 of depreciation made her basis smaller, right? So we recapture the depreciation. The rest is a 1231 gain. All right, the other things that could happen, right, in these recapture situations, what if Ashley had sold the computer for $8,000? So this is now less than she paid for it. Remember, she paid $10,000 for the computer originally, but she'll still have a gain for tax because depreciation made her basis lower. She has a $1,600 gain. So now, right, remember, we recaptured the lesser of the gain or accumulated depreciation. So the lesser here is the gain. That entire gain is now ordinary income, right? Because the entire gain was due to depreciation. And so she has no 1231 gain on this. What if she had sold the computer for $5,000? Right now, even with the adjusted basis, she still has a loss, right? I guess I could put parentheses around that, right? We have a negative 1,400. And sorry, losses are always on a 1231 asset are always just 1231 losses. They don't have to be recaptured under this rule. All right, so real estate, depreciable real estate, so buildings and improvements, they're going to be different. Don't ask me why. I mean, you can't ask me why. The real estate lobby, right, they're just very influential. So technically, depreciable real property is subject to recapture. Because just like other assets, a depreciable real estate, the gain could be bigger, or you could only have a gain because you've been depreciating that asset and giving a smaller basis. But the rules for real estate say you only have to recapture depreciation as ordinary income if it's accelerated depreciation, right? So the difference between straight line and accelerated would be recaptured. However, hopefully you remember from chapter 10 that we don't do accelerated depreciation for real estate anymore. It's straight line. So the bottom line is we don't recapture anything on real estate. There's something called Section 291. Just for your information, you're not going to be tested on this because we're not doing corporate tax, but corporations do have to recapture 20% of the gain that's due to depreciation. So since we have this gain on real estate that's depreciated, that's due to depreciation, but we don't recapture it, just what the tax law says now, it's called unrecaptured Section 1250 gain. It's the gain on real estate that's attributable to depreciation. So we don't recapture it and make it ordinary income like we do with personal property, 1245 assets, but we do keep track of it. All right, so we have this, okay, this is unrecaptured 1250 gain on this asset due to depreciation. I'm gonna keep track of it because when it comes time to calculate my tax liability, these unrecaptured 1250 gains on real estate, they can potentially get taxed at a higher rate. They're still capital gains technically, but they're taxed up to 25%. right? We'll get into the details of that in chapter 7. Right now, we'll think of them as being taxed up to 25%. So, right, to reiterate, the simplified takeaway for 1250, for depreciable real estate, aka buildings, we don't recapture anything, but the long-term gain due to depreciation is subject to a higher tax rate, up to 25%. So we don't recapture depreciation on real estate, but we do tax it, that part of the gain, at a higher rate. Suppose Ryan purchased an office building in 2001 for $700,000. He sold it in 2019 for $800,000. Right? With real estate, it's more realistic, right, that even an asset used in a business could increase in value. So he had claimed $320,000 in depreciation on the building. So what is his character on this gain from the sale? So his amount realized is $800,000. His adjusted basis, right, is going to be his initial cost minus accumulated depreciation. So 700 minus 320 will give him an adjusted basis of 380. So his gain is 420,000. All right, so we can see then from what he paid for it, 700, he sold it for 800. So I can see that 100,000 of this is a true appreciation in the asset. And that's going to be, right, a section, my little section symbol, 1231 gain. The rest, right, the 320, right, that's only because depreciation made the basis smaller. So if this was personal property, we would call that ordinary income. But because it's real property, we're just going to call this an unrecaptured section 1250 gain. Okay. All right, so in typing, right, see, technically we're recapturing 0, so that 320 is unrecaptured, and we want to keep track of it because we're going to tax it at a higher rate. And the $100,000 of true appreciation is still a 1231 gain that might get preferential treatment. All right, lastly, we're going to note, right, we have another number for you, section 1239. This deals with sales to related persons, right? So like an immediate family member or a large shareholder in their corporation or partners in a partnership, right? If you sell one of these, right, long-term business assets, depreciable or land, then if you sell it to a related party, all of the gain is ordinary income. What they're trying to do is prevent me from saying, okay, I'm a shareholder. I basically own this corporation. I'm going to sell an asset to it at an inflated price just because it's my money going anyways. I don't really lose it when I pay the high price. And then I'm going to take depreciation deductions on that higher basis, right? To make that not worthwhile, then all of the gain on the sale is ordinary income instead of being getting the preferential treatment, right? So simple, that's just to understand why, right? They're trying to prevent income shifting and potentially conversion. So, but all you need to know is that on a sale to a related party, all of the gain is ordinary income. If you sell something at a loss to a related party, you also can't deduct the loss for the same types of reasons, right? They don't want a related, you might be willing to sell low to a related party just so you can deduct a loss, right? And so they're going to stop that kind of tax planning, right? Following our theme of always the tax law, always looking closely at related party transactions. All right, we'll stop right there to not make this video too long, and we'll pick up on another video.